Hi, this is Bryan Rich from Money Markets TV. Just a few months ago, Wall Streeters and politicians were cheerfully telling us that an economic recovery was underway. Stocks had doubled from their lows of 2009. Manufacturing was showing signs of recovery. Commodity prices were soaring. Inflation was ticking higher in the US and abroad. And central banks were talking about normalizing interest rates, reversing the emergency measures they had rolled out in response to the global financial crisis and recession. For all these reasons, many forecasters were projecting 2011 to be a big year with growth above 5%, the kind of snapback that you might expect following a typical recession. But this was not a typical recession, and those same forecasters were ignoring several key indicators that weren't confirming recovery, like the labor market and consumer spending. But they explained it away, saying that these components were just lagging. They even put a gloss on the devastating disasters that hit Japan, touting that the fabulous growth would come from rebuilding after the earthquake and the tsunami. And worst of all, they failed to account for the impact of the sovereign debt crisis in Europe, even though the Eurozone's flaws had already been exposed. They told us problems were contained because they wanted us to invest more and confidently spend again. They wanted us to be active participants in the recovery. But unfortunately, they weren't eating their own cooking. The corporations didn't hire, the banks didn't lend, and nothing was done to resolve the debilitating housing crisis, which will continue to weigh on consumers indefinitely. But by now, most everyone has given up on that charade. It's become increasingly accepted that a robust recovery is not underway. Rather, another global financial crisis is looming. So now it's time to take matters into our own hands. First, protecting your wealth, and second, potentially profiting from this environment. For protection, build up your cash. Raising cash can help you avoid exposure to the destructive events that are likely in store for financial markets. For profit, go to the short side. Yes, the events unfolding in Europe and the global economy represent a lot of risk, but they also represent opportunity if you're positioned correctly. I believe that the two markets that will fall most in the coming downturn are the same ones that led the bounce in global risk appetite on the way up, the S&P 500 and the euro. You can capitalize on their declines or even just hedge against a portfolio loss by using inverse ETFs. For example, the ProShares Short S&P 500, or ticker symbol SH, is designed to give you a 1% gain for every 1% decline in the S&P 500. And the ProShares Ultra Short Euro, ticker symbol EUO, aims to return 2% for every 1% decline in the value of the euro. And both of these ETFs can be purchased in your normal brokerage account, just like any stock. I'm Bryan Rich from Money Markets TV. Thanks for watching.